Hello, folks. Welcome to the Born Trader. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today, which is Friday, March 6th, 2026. And today we are asking whether inflation has arrived, and we're looking at the whether stagflation, I'm sorry, has arrived. And basically, what we're looking at is the situation with the big drop in jobs at the same time that we see energy prices spiking and some other inflationary things taking hold. I want to take a step back and look at the big picture here because a lot of the pieces coming together might actually have some more kind of risk over the longer kind of term. And I want to kind of just go over those very quickly. So I want to just show a few quick disclosures here. And like we said today, jobs down 92,000 in February, more than expected. Now some of that was because of the healthcare strike. But then when you look out as well, there are some other things over time to be potentially thinking that we could see more of a. Let me just close that. Here is uh, the 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 payroll growth you can see now. Some of the things suggest going forward, it might also kind of have some other issues happening here. So you can see the payrolls here kind of continuing to trend lower, and you can kind of look over the course really of since more or less the middle of last year, especially in this calendar year. It's really been an overall story of weak job growth, and I think that's something that we all kind of know. But at the same time, I think we need to take a step back and look at the bigger picture. One of those things is that IT jobs, technology jobs down 11,000. This is also part of the idea of, are we going to see AI basically, come taking away certain kinds of white collar jobs and things like that? There is some evidence that that is actually happening. Now, another thing also is that we have Block, XYZ, the old Square, cutting a big chunk of its workforce. I think 40% of its workforce. Oracle is cutting jobs. Morgan Stanley is cutting jobs. So we have all those things together. Take a look here, the unemployment rate. So we also have rising unemployment. That's the month with missing data during the government shutdown. But we have had unemployment trending higher. So we have unemployment trending higher. At the same time, energy prices moving higher. That is potentially something that is kind of stagflationary. And I think it's important to realize that for a long time, we have not had conditions like this. We've had a kind of more benign environment. And some of the pieces now are coming together are not really pointing in the most positive direction overall for some of the macro conditions to support equities. We recently saw the producer price index last week was much higher than expected. This week, also, the Institute for Supply Management had its manufacturing index, and the price component of that index was much higher, jumped significantly. So we are already seeing some of that data, and that was data essentially from last month, from February, was January and then February. But the key thing is that we have been seeing already no real, well, we've seen some, signs of the inflationary situation remaining sticky, potentially getting worse as this year begins. So I think it's interesting to kind of see that. We saw the ramp up in some of the manufacturing stuff, and at the same time, prices shot up right away. We saw impact of things like tariffs pushing up things like steel prices. So we are seeing that as the parts of the economy did show signs of improvement, prices went right up with it, and that is the kind of inflationary part. But then you throw in things like structural job losses, and that is potentially more of the stag part of it, the whole lack of economic growth, and some of these conditions right now. I think when you look at some of the uncertainty that's happened because of political or policy decisions, there's a lot of uncertainty as well, which also argues against job growth and some of the things with our population now shrinking. All these things create a kind of uncertainty and a disincentive for for hiring, and that's, I think, what's kind of happening here. So as we look out into the future, we can also see that travel. I'm going to very quickly show you this daily chart of something like the airlines. Look at like American Airlines or any of these guys. Travel related stocks have gotten hit very hard. So travel saw job losses last month, and we have to expect. Well, I mean, it's likely to expect that given the current situation that we're going to see more weakness in that area. Just seeing international flights canceled, things like that. Energy prices going up, all that sort of stuff. It's pretty reasonable to expect that that's going to have a negative effect on things like leisure and hospitality, but also potentially on retail. So I think it's important to realize that right now, the actual economic effect of this uncertainty in the Middle East is basically has a potential to create a shock. And when I say a shock, I don't just mean the prices go up. What I mean is you have uncertainty. So if I tell you, like something bad is going to happen like tomorrow or something, you're going to be paralyzed and waiting to see how bad is it. It might in the end not be that bad, but it doesn't matter because when people know something like this is coming, it creates uncertainty, and the uncertainty creates inaction. The inaction creates lack of demand. The lack of demand creates lack of employment. That creates the cycle. So the whole thing about confidence is important. When you take away confidence, then basically a lot of these pieces that have all this positive momentum can go the other way, and then suddenly all the other pieces start, to weaken, and it's like an airplane, like gaining or losing altitude or something like that. So that's the key thing here, is that I think that the combination of, yes, energy prices at this point spiking, and we're going to get to that is going to be felt throughout the economy. It's going to be felt in inflation, but it's not just prices going higher. If it was going higher for a different reason, like there was an oil spill, or we had a lack of production or a strong economy, that would be different. But now we have it because of a lack of confidence. I mean, oil prices are still not that high. Historically, they have been higher. It's not about just the level. It's about the fact that there is uncertainty associated with it. And I think you're going to look out into the future, and you're going to see all kinds of projects, transportation, all kinds of manufacturing, and different kinds of parts of the economy that have involved investment. All those things suddenly become a lot less clear when you see energy prices going up like this. So I think that's important to realize. There is an aspect of economic shock that comes from something like we're seeing with energy prices. So let's just take a look here over here at my energy price chart on TradeStation. And I have this chart right here that I want to quickly look at. This is an index tracking gasoline prices, and we can see right here that energy prices, this weekly gain at this point, it's up 17-18%. And so that's the biggest increase since March of 2022, when the Russia-Ukraine war was starting. By the way, I want to remind people, please follow TradeStation on TradingView and watch the alerts, because I'm follow TradeStation here on YouTube and other channels, so you can get notified when we actually do some of these webinars. Today was not pre-planned, but I wanted to jump on this and kind of be able to do something with the breaking news that we have. So please follow us and check out our live streams. Make sure you're following those on YouTube. Anyway, we see this big spike in energy price, 17%, 18% to the upside in gasoline futures. Has been essentially gasoline prices. There's a lot of ways to measure it. There's all kinds of different prices throughout the country, but this is an index that is underlying some of the futures for gasoline. 17.5%, the biggest increase since the war began back here 4 years ago. It's kind of interesting. We are now basically at that 4-year mark of the Ukraine war starting, and here we are. A year ago we had the whole tariff spike. So kind of February and March have been tricky times for the market. We've seen, the war in, obviously the Ukraine war. Before that, we saw COVID, February, March, and now here we are, February, March. What do we see? We see basically this Middle East situation. So it's turning into a kind of a tricky part of the year for people. But as we look here, you can see, historically, we had this big spike also in gasoline prices here coming out of the pandemic. But, this is a pretty significant increase. And I think a lot of people, it hasn't really trickled through to the real economy yet. So it's important to kind of realize that. All right. So the other thing, though, is that we see problems with credit. And I think it's important to realize here is that there has been a growing drumbeat in the background of credit problems. And so the thing is, you have energy prices spiking, and you have, that. What does that mean for the Fed? And things like inflation, that has credit not follow through. Also, at the same time, if you have a weaker economy, that also hurts credit markets. It means that there's higher defaults, more bankruptcies, things like that. So what's interesting is UBS put out a note a few weeks ago, basically saying that the AI could cannibalize a lot of software companies that are owned by private equity. But see, the thing is that in many ways, people don't think about this, but it definitely has that kind of, it's had a real negative effect in the last 2 months on software companies. People see these increased competition and things like that. But the other thing I think is that people don't realize is that private equity has gobbled up huge amount of companies in this country, tens of millions of employees under them, and all those companies are leveraged to various extents. So if we go into a period of higher rates and a weaker economy, those two things together could create some real problems across private equity. Now, you don't want to be an alarmist or say how bad things might be. I would never predict something like that or anything like it, but people are starting to notice it. And again, it's one of those things when you're in the early stages of something happening, that's when price moves. Now, maybe it moves for a while and then, it's not so bad. But in the early stages, people think, you know what, the odds maybe look for something getting weaker here, and that's the kind of direction things are going. So I think it's important to realize here that we had BlackRock write down BLK. We did a TradingView idea on this today. If you want to check it out over here on TradingView, we did a TradingView idea on BlackRock, and then the stock gapping down today. If you take a look at this, BlackRock goes in the red. Check this out. You see the stock gapping lower here. But basically, the thing is that these guys now have credit problems. They basically wrote off a loan full loss, from 100 to 0 in a few months, and now they're slowing redemptions at certain of their funds. So these are the kind of cracks we've seen. We've seen the same thing with Blue Owl and things like that. So again, you don't want to be alarmist and say it's 2008 all over again, or anything like that, because it's not necessarily. But the thing is, we are early in the process, and the thing is, very often when you're in markets, the move comes early, and then does it continue or does it stop and reverse? It could stop and reverse, and hey, it's not so bad. But the point is that the early stages of the move, that if that's where we are now, it means that in many ways that negativity has not yet fully priced itself into the market, and it may not have, and that may have the potential. And that's, I think, the key thing to look at today, because this is a Friday with a lot of uncertainty, and it could be a kind of difficult afternoon. So I want to kind of mention that. Um, so um, so now we have the situation with the Middle East, obviously. And if you look at oil, I think, we all know that oil is jumping today significantly. But I think it's interesting to see that Trump basically is demanding an unconditional surrender. So, however you think about that, at the end of the day, it does mean that we're not near a resolution, and we're going into the weekend when a lot of stuff can happen. So I think that's kind of interesting to be aware of. And then the other thing is that we see Kuwait reducing some oil production. We see more attacks on Bahrain, where we have a huge Navy base. So you put those things together here, and you go into the weekend, and we might be in a spot where there's really not a lot of reason to be overly, optimistic that we have a quick resolution to these things. And with the weekend coming and everything else, people might be focused more on risk going into the kind of weekend. So let's look at the S&P here. Now, we did an idea earlier. We did an article early in the week focusing on the 6,800 level on the S&P 500, which is right here on this chart. In fact, look at this. This is the chart from my article here. Few things to look at. First of all, 6,800 is the line right here. You can see how we've mostly stayed above it. And then we just fight each time we've gone under it, we've snapped back quickly. And that has happened again. And now we're trying to hold 6,800. But there's a few other things kind of happening here. First of all, if you really look, the low of January 20th was not 6,800. It was 67. It was around 67. Well, I'm sorry, 67 70 area. But the key thing is that in here, this whole range, you can see kind of between 6770 up to 6800. This entire zone we've tried to turn into support. It has been support, and now if you look, we're getting stuck under it. And I think that's the important thing, is that we see that this has been a very tight range for a long time. Now, the other thing that's important to realize is look at Bollinger Bandwidth. Bollinger Bandwidth has narrowed significantly. So when you see other moments of Bollinger Bandwidth narrowing, look right here back in February of last year. Bollinger Bandwidth got extremely narrow. The market was narrow near highs, and it sold off. And then if you look at other moments as well, like back at the end of 2021, you saw the same thing. If you look here in November of 2021, that entire period saw Bollinger Bandwidth narrowing. So what does it tell us? It tells us that the market is moving less, and as it moves less, it has that potential to be more to expand and suddenly turn into an increase of volatility. It's called a volatility squeeze, and we are seeing conditions right now to suggest that that is kind of happening. So I think it's important to realize here as you look at this chart. Now, another thing is look at RSI on this chart. Well, actually, let me first mention one other thing on this chart I forgot to mention. Look at the moving averages. So you can see now that all the moving averages, I have the 10-day, the 20-day, the 30-day, the 50-day. You can see the reason for this is to show the sequence. The faster are below the slower. And that tells you that we've now flipped the other way. When you're in an uptrend, the 20-day should be above the 30-day, and it should be above the 50-day. Like here you see the blue is above the purple is above the red. Now we have just the opposite. We see basically that the blue is under the purple and it's under the red. That means that the short-term trend and the intermediate-term trend are potentially showing increase, more of a bearish sort of setup. So that I think is interesting also. So now take a look over here at this chart. This chart has a few things. First of all, it has RSI. And what I think, you look at a situation like this, our RSI is just kind of crumbling, but it has not been able to get as high. It just keeps trending lower. And then the thing is when you look at RSI like this, it might be a situation when, it needs to just go down and slam down to some kind of oversold condition. I mean, it's very neutral here, but the thing is, I think to realize is that it's showing a lot of neutrality with things like this level trying to hold, but this also might have the potential to suddenly just really need to get down into the oversold levels like you see at other times when the market just kind of staggers. You see, it just kind of does nothing, and it needs to kind of get down to oversold to wash out and kind of refresh for some kind of other rebound. The other thing is that the MACD is pointing kind of lower here. So another thing now is that's MACD. We're under the 50 and the 100-day moving average. We want to point out. Now we look at the weekly chart. We do our Monday webinar, State of the Market, on Monday at 2 p.m. Eastern, and we look at mostly the weekly indexes, the big indexes, the weekly charts of the big indexes. Very interesting here. Look at the high for this week, right around 6,900. That is the lowest weekly high since the week before Christmas, right back here. So the high this week is the lowest weekly high. It's also the lowest weekly low since back here in November. So we have the lowest weekly low since late November. We have the lowest weekly high since late December, essentially. We're also on pace for our lowest weekly close, also since November. So when you look at the chart like this, I mean, I think you can see that there is like a topping sort of pattern here, a rounding sort of topping pattern that people might be seeing and viewing that as something of a kind of potential risk. Now, the other thing is, let's take a look on this shorter term chart right here. This is a 15-minute chart of the S&P futures. Now look at how we have this level, which is basically the low from yesterday. Look at how we're getting stuck under it on the 15-minute chart. So this is something I think really we want to kind of see. This level is also, I think, something right here that people can be focused on as being maybe a potential resistance point right across here. And you can see where our high was today. If you look at the S&P index, for example, you can see this also. This is now the cash index, which doesn't show the overnight trading, but you can see this low from right there that we've been stuck under. So people might actually be looking here at 11:31 Eastern, 4.5 hours to go. But as we get into the afternoon, if people stay, remain under here, the attention might turn back to that geopolitical uncertainty with the weekend coming. So I want to mention that. And these are the main things I wanted to show. I want to very quickly just mention over here, if you look at the Fed, if you look at the Fed, the CME Fed Watch, you can see that we had gone to a period here of expecting, yesterday we expected no rate cut in June, and now we're back to maybe a little bit closer to a rate cut in June. Why? Because people look at this jobs number and they think we have a recessionary environment. However, if you look at the energy situation, that is not, necessarily going to favor a rate cut. And the other thing I think just to realize is that if the energy shock is caused by a supply shock, which this is, no oil exiting the Persian Gulf, then American jobs can disappear and demand can disappear, and it's not going to create that cyclical downturn in demand in prices. So I mean, at some point it will, but the point is that this connection, this assumption that weak employment results in lower energy prices and lower inflation, this time it might not be like that, and that's why we ask whether stagflation is returning, because this is similar to what people saw in the 1970s when stagflation happened. And you just want to point out that some of the different pieces are in place for this, and I want to kind of break that down and kind of show it to people. So I hope everyone has a great weekend. We'll see you Monday at 2 p.m. Eastern for State of the Market. Take care and have a great weekend.